Hi, everyone. It's Chad back with another episode in Base Firma's latest podcast series on transfer pricing controversy trends around the world. Today, we're turning our attention to one of the world's largest and most globally integrated economies, People's Republic of China. To this end, I'm thrilled to be joined by Jacky Mao from ThinkBridge, our China transfer pricing partners. Jacky, welcome to the show. Perhaps you can kick us off today with a few words introducing our listeners to yourself and to ThinkBridge.
Yeah, thank you, Chad. I'm very pleased to have the chances to join this, podcast. And I'm a tax partner from ThinkBridge China. And first of all, to introduce, ThinkBridge China is a professional accounting firm, registered in Shanghai, China. And we also have a Beijing satellite office. With these two offices, actually, we are able to assist many of our MNC clients, for some professional services they need for their operations in China. And for ThinkBridge China, it is a member firm of HLB network. And we majorly have three service lines. The first one is the financial advisory. The second one is the audit and bookkeeping services. And the third one is the tax advisory services. I'm a partner in charge of the tax advisory services. And our service capacity includes actually some PRC tax advisory services like covering the fields like corporate income tax, PRC VAT, transfer pricing, and also some customs issues. So in the past, decades, actually, we are managed to assist many of our MNC clients in supporting their PRC advisory related projects. And I think some of the project definitely includes some assisting them in some supply chain restructuring, on transfer pricing compliances, on some transfer pricing audit defense, as well as some of the cross-border, APA, discussion with the state administration of taxation, which is SAT, the national, in charge tax bureau for transfer pricing, matters. Yeah, just to introduce Chad.
Great. Thanks so much, Jacky. And just personally speaking, I've had the pleasure of working with you in ThinkBridge on a few transfer pricing compliance and controversy projects, and it's always been a great experience. So, Jacky, we're super excited to have you on. Maybe we can start off our podcast today by giving our listeners a quick overview of transfer pricing requirements in China. So a lot of our listeners are familiar with US, OECD, kind of more standardized transfer pricing compliance and requirements. What makes China unique? What are the general requirements for transfer pricing for large multinational taxpayers?
Yeah, sure, Chad. Yeah, I think, on a high-level basis, I would say China generally, actually, in the local practice, generally embraces the concept of the OECD transfer pricing guidelines and also the arm's length principle. And I think the history of the transfer pricing regime in China is not that long. I think the national SAT built up the framework for transfer pricing around back to maybe 14 years ago, which is in the 2009, actually, there are a major, transfer pricing regulation published, which is Circular 2. So in subsequent years, actually, there are also some new supplementary transfer pricing circulars published, which forms up, the current, framework of the China TP regime, I would say. And overall speaking, I think most of the local regulation, follow the OECD guidelines. And also the SAT has, in the past few years, responded quite actively, to some OECD, say, for example, BEPS, action plan, and also some new discussions on Pillar 2, etc. And also under the framework, there are some of the very hot, I would say, very commonly seen topics like thin capitalization, and also the CFC rules. There were also some corresponding, supplementary, tax circulars published in China tax regime with the aim to help the local in-charge tax authority administration on this kind of, transfer pricing related, topics. And I think this is the general framework. And also there can be also some very unique point or some special clauses, in the local practice in China for transfer pricing. And I think one of the key items maybe we will also further discuss is about the transfer pricing audit. And according to the local regulation, of course, the China SAT admits the inter-quota range concept, in the OECD guidelines, but in the formal transfer pricing, there is a local regulation circular which clearly stated that the local tax official is empowered to adjust the target company's profit margin to a medium level derived from a benchmarking study, in a formal TP audit. So this is maybe one of the key, I would say, highlight area or some or a key points, for China transfer pricing audit purposes. I think this there are many differences, in details, compared with the OECD guidelines, but I just want to highlight that this can be considered as one of the key differences or key focusing areas if we compare with the China TP regime with the OECD guidelines. Yeah.
Great, Jacky. So to recap, general alignment with OECD in terms of compliance. So I think for large taxpayers, and if my memory serves, that's something like 100 million to 200 million renminbi, just dependent on the nature of transactions, right? You'll have your master file requirement, your local file requirement, and also some sort of country by country requirement as well.
Yes, you're correct, Chad. And I think to introduce, actually for a taxpayer, for a multinational taxpayer in China, so basically the minimum requirement is that you have to file a so-called RPT forms, which is related party transaction disclosure forms, in your income tax filings in China. So this is a minimum requirement. As long as you incur some related party transactions for the year, as a taxpayer, you have to file this minimum compliance requirement. And also the country by country reporting, if the taxpayer or the group satisfied a certain threshold, then you will have to file a disclosure form called CBC reporting forms. This is also an element contained in the annual income tax filings in China. So this is actually the tier one thing. And also in the China TP regime, there are so-called 3 tiers, transfer pricing documentation, mechanism currently. So which involves, as Chad you just mentioned, the local files and the master files, and also some special purpose file documentation. And the local file, I think most of the multinational clients, they should be very familiar with. As long as your annual transaction related party transaction volume exceeds certain threshold, then the taxpayer in China is obliged to prepare this kind of TP transfer pricing local file. And for the master file, if say for example the group has prepared a master file, per their local countries requirement, or the annual group related party transaction volume exceeds the 1 billion CNY for the year, then the local China subsidiary is also obliged to provide the Chinese translation of the master file to the local tax authority. Actually back to I think in recent months we have also seen the China Tax Bureau try to collect the master file from the local subsidiary in China with the aim to gain a deeper understanding of the whole supply, the situations at the group level. So this is about the master file. And lastly, I think that this is called a special purpose, TP documentation. And according to the China regulation, it covers the sink capitalization reporting and also the cost sharing agreement. So I think for the cost sharing agreement, I would say in the past decade, there are actually very limited, reported cases of concluding, cost sharing agreement with the China SAT. So this is seldomly seen actually in the local practice. But if the taxpayer they exceeds the sink cap ratio of 2 to 1 in China, then the taxpayer is obliged to explain whether the interest rate arrangement, the sink capital ratio exceeding the threshold, whether it's still complying with the arm's length. So they are obliged to prepare this kind of special purpose, documentation. So in all, I think this is the so-called 3-tier, transfer pricing documentation requirement in China.
Great, Jacky. So now that we have that framework or that baseline knowledge of Chinese transfer pricing compliance requirements. I'd like to shift our focus a little bit more towards the Chinese tax authority, the SAT, and their approach to actually synthesizing, those compliance requirements into audit requests, right? Information requests, or any other sort of transfer pricing controversy related procedures. So could you give us a little bit of an overview on how the SAT notifies taxpayers of their intention to launch a transfer pricing or tax audit? How long would they give taxpayers to respond in the event of an audit? And anything else you might want to mention that's important in terms of the procedural aspects of Chinese tax controversy?
Yeah, sure, Chad. I think this is also a interesting topic to all of us. And I think first of all, if we're talking about the China tax authority's approach to TP audit, I think first of all, I want to share with you a topic which is how or the resources on how the China tax authority will identify the potential candidate for the TP audit. So according to the regulation and also some local practice, in our observation, I would say there are majorly four kind of resources which the China tax authority uses in determining the potential candidate. And first of all is, as you may be aware, there are some, automation, system called golden tax system recently introduced in China tax authority. So on a high level basis, they will try to use some tax filing data and also as we just introduced, some local file information, some RPT forms information. They will use this kind of information as a big data and build their own monitoring model. So under this kind of calculation or model, they will try to identify some suspicious candidate, and they will form up a candidate pool, and they will basically use a random pick from this pool and to identify some appropriate candidate or taxpayers to launch a transfer pricing audit. I think this is the first sources. And the second one is that back to maybe before the COVID, our observation also indicates that the SAT has launched some nationwide, industry-wide, transfer pricing investigation on some top industries like automotives, like retails. So this is a second one. So as long as the SAT officer, they have interest or they have some strong confidence that they can identify some TP incompliance issues for a certain industry, so normally they will choose to launch a nationwide, industry-wide investigation and focusing on some key players with this specific industry. So I think this is the second, resources. And the third one is that in past years, actually, once, say for example, there's a transfer pricing audit which successfully conclude with the taxpayers, sometimes the in-charge tax official at the provision level, they will try to use their concluded cases as a credential and try to identify if within their region, within their province, within their municipal, if there is a very similar, taxpayers have a very similar transfer pricing arrangement, and they will also launch an formal or informal transfer pricing audit with the aim to see if they can collect, income taxes, based on a very similar, TP transfer pricing, issues. I think this is the third, resource. And then lastly, I think it is also made it very clear in the China tax regulation, which is that generally the China tax authority will encourage some outsiders or some insiders, even insiders, to share some clues or some key messages if they identify that a certain taxpayer is regarded as incompliant with the arm's length principle. So yeah, you can see we have also seen recently some cases that some employee of certain MNC clients, they share some of the info message with the SAT, and the SAT has also, based on this kind of information collected both internally and externally, and to impose some transfer pricing inquiries on this. Yeah. So I just want to highlight first of all some of the key resources or clues that China SAT will normally uses in the local practice to launch a TP audit. Yeah.
Very interesting. So in addition to kind of the more traditional resources of, the transfer pricing compliance, filings, master file,
Mm-hmm.
local file, there's also other considerations. You mentioned automotive and retail as being particular industries of interest when the SAT is, evaluating companies for audit. I'm curious, in addition to industry, and we all know that there's some sensitive industries, both from a domestic and international, geopolitical standpoint, international trade wise, right? But specific to different types of transactions, intercompany transactions. Are there
Mm-hmm.
certain types of transactions, let's say maybe the transfer of intangible property? You mentioned cost sharing, right? Are there
Mm-hmm.
are there certain transactions that may draw scrutiny on a more regular basis, or may draw more intense examination from the SAT than others?
Yeah. I would say the answer on a high level basis is yes. And just to introduce our observation, actually, in recent months is, in some TP audit cases, and it turned out that the China tax official, they are focusing on some, I would say, traditional hot, transfer pricing scrutiny items like royalty license fee arrangement. And another, very key focusing area, post the COVID, years is the intercompany service recharges. We have seen actually a very typical cases is that for many MNC clients we here with US or EU headquarters, post the COVID, the headquarter started to impose some or say enhance some say for example share service recharges with the allocation of all the senior management's cost or some SSE cost to the beneficiary subsidiaries. This kind of enhancement actually in the local practice has also triggered the local tax bureaus attention or interest. So during their review of your proposed enhanced intercompany service recharges, the things like the inherited from the OECD guidelines, some beneficial testing or some very similar concept will be applied in their review to see whether there are authentic intercompany services rendered from your headquarter or some affiliate company or not. If there's no sufficient supporting document which can prove the authenticity of this kind of service rendering, the China TP officials together maybe with the income tax bureau officials will try to deny or ask you to make an adjustment on this kind of a relatively aggressive SSC recharges. Yeah, just to share. And of course, if we're talking about other transaction type, I think recent months is the share transfer will be a key focus area. And also, Chad, just as you mentioned, some intangibles. We have seen many M&A activities in recent months, and there was discussion, very detailed discussion on things like the transfer of some client relationship or some other intangibles, and how to evaluate the appropriate value from a China transfer pricing perspective has always been a hot topic recently. We also see some tax officials, they are laying or put some emphasis on some transfer pricing topic like exit charge. Many of the production side, maybe they are shifting some of the production capacity to some Asian region countries, and the China Tax Authority is also interested to impose inquiry on whether there are some exit charges and whether the appropriate compensation should also be made. Yeah.
Great. Thanks for that, Jacky. It's an interesting combination, right, of, relatively sophisticated tax authority and the SAT, especially compared to, other tax authorities around the world in their approach and their ability to synthesize and collect data for audits. And also, although there's general alignment with the priorities of the OECD and the BEPS, 2.0 framework, also some local considerations, right? As you mentioned, industry considerations, transactional considerations.
Yes.
I love that you mentioned exit tax, right? So it's a complex tax environment as well. So on that note, I'm curious to wrap us up for today. What, in your opinion, might be the 2 or 3 most important steps that a taxpayer can take, either A, to avoid controversy risk in the first place, or B, in the in the possibility that they're already in that controversy environment in the People's Republic of China to mitigate any sort of ongoing controversy proceedings that they might find themselves in.
Yeah. I think my first reaction to Chad, your question is that I think the minimum requirement for MNC clients, my suggestion will be that the local transfer pricing local file should be well prepared, because this kind of local file normally in the context of a transfer pricing audit should be served as a first tier defense file. Right, the local tax bureau once they launch either a formal or an informal TP audit, they will request first of all you share with them the details and the explanation of your local file. What is the characterization of your local entities? What is the function and risk profile, etc. So I think local file is important, and we should be well prepared to defend the potential inquiry from the local tax bureau. I also recommend to many of our MNC clients is that, if you're interested in this, then we will normally suggest using a house check, because sometimes, we as a professional should have a third party view, on your intercompany, pricing arrangement. Right. And it's much more easier for us to identify if there's any suspicious or some incompliance areas which need to be fine-tuned or adjusted. So I think the house check consideration is also quite important to identify if there's anything or any corner which the management is not aware. But anyway, still it will be viewed as a quite important TP issues in China local practice. I think this is second point. And if we're talking about how to mitigate the transfer pricing risks, I think the first prioritized item is that if there's any TP issues are identified, we will recommend the MNC clients to closely monitor the implementation stages of the TP mechanism. And of course, periodically, if we identify there's anything inappropriate, we will suggest we have a periodical adjustment or true up on your intercompany pricing mechanism. I think by doing so, this can largely mitigate the TP risk in local China practice, rather than accumulated this kind of rather than doing nothing and accumulated the transfer pricing risks. And to a certain extent, this may trigger the attention from the local tax authority, and which may lead to a formal TP audit. And secondly is that if, say for example, there's no periodical true-up or adjustment performed, then I think the last resort for you to mitigate the TP risk is to trying to perform some year-end adjustment. Of course, year-end adjustment can be a very complicated, cases here in China. But anyway, I just want to highlight that we have seen in past 1 year or two, the China Tax Authority has also co-worked with some local Forex Bureau officers and also some customer bureau officers with the aim to have a similar to, I would say, a very similar advanced ruling system with the aim to facilitate the capital conversion of the intercompany compensation. Sometimes we need to compensate the China entity. We should have cash flow inside of China, and sometimes there's some residual profit, and we have to repatriate that outside of China. But anyway, I think with the facilitation or the co-work with the local Forex Bureau, we have seen in some first-tier cities, the Forex, the capital conversion, for this kind of year-end adjustment or year-end compensation will become a bit, convenient for the multinational clients. Yeah, just to introduce.
And so to tie what you just mentioned back to something that I think you brought up at the beginning of the episode, to any taxpayer considering a year-end adjustment or a transfer pricing true up or true down, right? So rather than, some tax authorities method of adjusting to maybe the nearest quartile or somewhere within the arm's length range, the Chinese tax authority guidance, the SAT guidance, is generally adjusting to the median. Is that correct?
Yeah, under the context of a formal TP audit, yeah, they are targeting a median. But for the daily compliance purposes, per the local regulations, they still admit the arm's length principle. Yeah, the interquartile range. But anyway, if the taxpayer is identified to be, say for example, their profit margin is significantly lower than the IQR, then they will have the authorization, or they are empowered to launch a formal TP audit. So under the context of a TP audit, they are empowered to adjust to the median. So I think this is also a key message.
Excellent. Well, thank you for that clarification. And Jacky, it's truly been a pleasure having you on our show. And I want to thank you so much for sharing your valuable experience and expertise in such an important and frankly complex aspect of global transfer pricing controversy. And I highly encourage any of our listeners interested in learning more about Chinese transfer pricing controversy and or compliance to reach out to us and ThinkBridge as well. As always, you can find contact information in our show notes. Jacky, well, thank you again for joining us. I very much look forward to continuing collaboration with you into 2024.
Yeah, thank you, Chad. And very nice. Our pleasure to have the chances to be on this podcast and talking to you. Yeah.
Great. Well, that's all for today's show. Tune in again soon for more interviews and insights covering all things transfer pricing.